Imagine two companies. Both post consistent profits and look identical on paper. But beneath the surface, one is quietly running out of cash. The difference comes down to a simple misunderstanding. Profit is not the same thing as cash. Confusing the two has cost investors more money than almost any other mistake. To understand why, look at how businesses measure success. Net income comes straight from the income statement. It's a basic calculation: revenue minus expenses. The catch is accrual accounting. On this timeline, a sale is recorded the moment it's earned, not when cash hits the bank. The exact same applies in reverse. Expenses are recorded when incurred, even if paid months later. Because of these rules, reported profit is partly real money and partly an accounting construct. Without explicitly tracking the actual dollars moving in and out, a business leaves itself highly vulnerable. That's why financial experts look past the income statement and focus on a different metric: cash flow from operations, or CFO. It answers one specific question: how much actual, tangible cash did the business generate from running its day-to-day operations? This diagram outlines the exact formula. You start with net income, then you add back any non-cash expenses, and you adjust for changes in working capital. Let's see how this works in practice with our first business, Company A. This chart shows their surface-level performance. They report $1,000 in revenue minus $800 in expenses. That leaves a very healthy-looking net income of $200. Now let's adjust for reality. Out of that $1,000 in revenue, $400 of it was sold on credit. The company hasn't collected a dime of that in cash yet, so we have to subtract that $400 increase in accounts receivable. Next, the company recorded $50 in depreciation. That reduced their initial profit on paper, but no actual cash left the business to pay for it. So we add that $50 back to our total. Do the final math, and you get a cash flow from operations of negative $150. This company reported a $200 profit, but actually lost $150 in cash. Trusting profit blindly creates a massive blind spot. A company can look highly successful on paper while simultaneously bleeding the exact resource it needs to keep its doors open. The mechanism driving this difference is working capital. It consists of accounts receivable, inventory, and accounts payable. Think of working capital as the bridge that connects a paper profit to actual cash in the bank. When receivables or inventory go up, cash is trapped. It's tied up in unsold goods or IOUs from customers. But when payables increase, the company is holding on to its cash longer by delaying payments to its own suppliers. Now, let's look at Company B. At first glance, this financial breakdown shows a weaker business. Revenue is the same at $1,000, but expenses are higher at $850. The resulting net income is only $150. But look closely at their working capital adjustments. Receivables increased by only $50. Inventory stayed completely stable. Meanwhile, they increased their payables by $100, keeping more cash in-house. And they have $40 in depreciation to add back. When we run those numbers, we find a cash flow from operations of $240. Despite the lower paper profit, this company generated significant actual cash. This is the exact point where expert thinking diverges from beginner thinking. Beginners see Company A's higher profit and stop digging. Experts follow the cash, and they choose Company B. This divergence becomes incredibly dangerous when it's time to value a stock. The most common metric investors use is the price-to-earnings, or PE, ratio. It divides a company's market price by its net income to tell you if the stock is cheap. Let's assign both of our companies a market value of $2,000. In this comparison matrix, Company A has a net income of $200, giving it a PE ratio of 10. Company B, with its $150 net income, has a PE of 13.3. Under this standard model, Company A looks like the cheaper, better investment. But watch what happens when we evaluate them based on cash. Using price to cash flow, Company A sits at a negative ratio because it's bleeding cash. Company B boasts a very healthy ratio of 8.3. The entire picture flips. Relying on the PE ratio alone is a trap. If those earnings never actually convert into cash, you aren't buying a bargain, you're buying an illusion. There is a persistent myth that profit is the ultimate measure of a company's success, but history is filled with businesses that posted steady, rising profits right up until the exact moment they collapsed. They didn't fail because they lacked profit. They failed because they ran out of cash. The root cause of this is time. Accounting tries to match revenue with expenses, regardless of when the money moves. If a company records a sale today but doesn't get paid for 90 days, profit exists on paper for 3 whole months before a single dollar materializes. To avoid getting caught in that gap, you have to watch for specific red flags. If profit is growing but cash flow is shrinking, that's a warning. If you see massive spikes in accounts receivable, it means the company is aggressively booking revenue but failing to collect the actual money. Conversely, look for green flags. A highly resilient company will consistently report cash flow that is higher than its net income, accompanied by stable, predictable working capital. Now, a gap between profit and cash isn't automatically a sign of danger. Sometimes a fast-growing business will intentionally consume cash to build up inventory for a major expansion. Experts investigate the specific cause of that gap. They study the movement in inventory or receivables to determine if that missing cash is a sign of trouble or a strategic investment in the company's future growth. The market rewards resilient cash generators because cash allows a business to reinvest, pay down debt, and weather economic downturns. While profit is a matter of accounting opinion, cash determines a company's survival.